Hello and welcome to Admiral Markets webinar of 24th of April 2014. All you need to know of stop losses. Today Chris will be with me and we will show you together how to use stops when trading. As always, be sure to check our Admiral Markets blog. This was the analysis from today. As you can see, both setups were valid below 38.10. 37.90 was hit, above 38.10. Euro is jumping up, so excellent. As always, we try to be excellent with our analysis, so pay attention to that. Our disclaimer: online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting, conditions, and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Then, second part, risk disclosure statement, citing all possible risks associated with Forex market. By proceeding further, you are basically accepting all the risks associated with Forex market. Then, Admiral Markets UK Ltd takes no responsibility for information accuracy. The analysis represents the personal opinion of the author, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business. This is personal opinion only, and this webinar is for informational and educational purposes only. With having said that, today we are going to talk about stop loss. So first, what is a stop loss? And then we will talk about types of stop losses, and then I will show you live chart to see how I basically count and how I do stop loss, how I fix my stop loss. So basically, stop loss is an order which limits investors' potential loss on a Forex position. It's also known as a stop order. Remember this, guys, now and forever. If you have, let's say, a buy entry, let's say that you have a buy entry. I will use this pen. Let's say that you are long. And when you close your long position, what platform does is basically it's automatic sell into the market. But you don't see that. You just see that your position is closed. And now imagine that many positions have been cut at the same time. What would you see is the sudden reversal of the market. So every and each close of the buy position is automatic sell into the market. And each close of sell position is an automatic buy into the market. And that is what we basically do not see. That is what platforms do for us. And platforms do that for us. And we basically just hit close. Our order is closed, but that is automatic sell into the market. So that is also very important. Now, when you have a stop loss, basically it protects you from further losses. So stop loss is executed at a given price, but if the market is very volatile, you can experience a slippage. Sometimes, you know, maybe when you trade, if you have, let's say, a long order, and your stop loss, let's say, is here, and there is a sudden spike after the news, let's say, for cable, what you can experience is basically that your stop loss did not close there. Basically, the price went through it, and your trade was closed there. So that is a slippage. That is usually 1 to 10, 15 points from your stop loss order. And that exclusively happens usually when market is very, very volatile. So that is why I also don't advise trading the news. Back in days, I traded the news, but nowadays, you know, when I trade 23, 24 pairs, I don't need to trade the news. But someone may trade the news, and there is means how to trade the news, but you need to know that stop loss sometimes is not executed at the right price just because of that big volatility and huge momentum spike which follows the news. Stop loss means stopping the loss, and that is why it's called a stop loss. So stop loss is actually stopping the loss, okay? Now, advantages of having a stop loss. Basically, the biggest advantage is that we are protecting our equity. So our equity is being protected when we use and when we apply stop loss. Not using it on leveraged trades can end our career in Forex market. That is also the truth. If you don't use it on if you use it on leverage trades, you can basically prolong your career and be a profitable trader. But if you don't use it on big leverage trades, usually that can end your career in Forex market. Quick exit of the trade when it goes below or touches the stop loss, and the peace of mind. So basically, you know what I mean by this. If you let's say that you are sitting in front of your computer or trading station and you need to do something. You basically will stand up and go and do that, but while you're doing that job you need to do, also your platform trades your money. So if you are exiting, if you are going out, you need to put stop loss just in case something goes wrong. So that is also a big thing to do, because if you trade without the stop loss, who knows what can happen only once in a lifetime that can easily wipe your account. Disconnection proof also, sometimes your platform may get disconnected, and usually we refer to that as server problems, even though brokers, most of brokers, and even Admiral Markets one has more than 15 servers. I don't know how much, but it has a lot of servers. Sometimes those servers may get disconnected. If that happens, your stop loss will basically save your equity. Also, it can save your platform malfunctioning. So if your MetaTrader 4 gets attacked by a known virus, which happened to me 4 or 5 years ago, or maybe there is a problem with your computer and MT4 platform, don't worry, because stop loss will automatically protect you from further losses. It will, if your stop loss is hit while your platform is shut down, it doesn't matter. It will be respected. Now, what are disadvantages? Sometimes brokers' awareness of stop loss orders. You know, guys, that many brokers basically use that is their tactics which they use to basically hunt stops of their clients. Fortunately enough, I'm a witness that Admiral Markets do not do that. Just a simple explanation. Today I had if you followed my this is a great example for this. If you remember, I had a long trade on GBP dollar, and I have put that here on Spider's Den, and basically this was my entry: 67.85 and 67.95. And to be honest, what happened was it went 0.2 pip from my stop loss, and it didn't close my trade. So after that, I was 2-3 pips in a profit. I closed the order for 2 or 3 pips, because you know, usually when my stop loss is to be hit and it doesn't get hit, if it gets to break even, I would usually close it at break even, or maybe 1 or 2 pips of a profit. And that actually happened today, and that is the perfect proof that Admiral Markets really do not hunt client stop loss orders. 0.2 missed. That is incredible. Then psychological failure when stop loss hits and reverse. Also, you need to know that if you place your stop loss too tightly, sometimes your stop loss will be hit, and then the trade will proceed in your direction. But that can be assumed as psychological failure. And that is a very, very nasty thing if that happens, because it can affect your psychology and you won't be calm when that happens. Also, disadvantages: if it's placed in a wrong place or time, it can be actually working against you. So you need to know where to place your stop and where to put it, when, which time frame you trade. If you're not sure which and where to put stop loss, use general rules which me and Chris will present you today, or ask your mentor or whoever sold you the system where to put stop loss. Then also that of 1,000 cuts, continuously trading with small stop loss that gets hit each time. Multiple times position is opened. So if this is your entry and your stop is too tight, basically what will happen, you will get stopped out, and again the trade will reverse, and if you weren't stopped out, your trade would be in profit. Then it can happen again, you open your order there, but still again your stop loss is really small, it can get hit, and the trade actually will continue in your direction. It doesn't mean that your system is bad, it means that you are not following the rules and you don't know where to put stop loss, or eventually you like to trade with small stop loss. I actually don't recommend stops lower than 15 pips on scalping. On intraday time frames, usually around 30-35 is good stop loss. So basically you need where to put stop loss, and you need to be aware of your stop loss. If you don't do that properly, you may get stopped out very frequently, and actually you might be getting later you might be getting maybe some psychological problems with that, because even though you know that you're right, well, if you're stopped too many times, basically it can affect your psychology. Then types of stops. We have percentage stop or equity stop, technical, chart stop, fixed stop, mental stop, time or hourly stop. We have those types of stop losses. So let's see what they are basically. A percentage stop is a stop which uses predetermined percentage of trader's account. Usually percentage stop is 3% of trader's account. With this method, stops are usually small if trades are leveraged. There are no many entries, it's usually a single entry, and not many traders do that because it's arbitrary stop loss. Basically, if you do percentage stop, you're judging your entry point with your stop. So if you're risking 3%, every time you open a trade, your risk will be 3%. Then you need to adjust your stop loss to that 3%. That means that if you basically use 10,000 account and 30 pip stop loss, it's always fixed. It's always 30% of the stop loss. But if you ask me, that's too much of a risk, so it needs to go lower. So percentage stop is a form of fixed stop, is a form of percentage stop and technical stop. But I would say that percentage stop is a perfect example for arbitrary stop loss. So basically, once your percentage goes above that predetermined level, you will close your trade. That also has to do with your mentality. So I don't recommend percentage stops, but some traders do it actually. Then there is mental stop. Mental stop is the worst way to put your stop loss. Using mental stop is a combination of percentage and technical stop. It needs constant monitoring. It's usually done on big volatility and slightly leveraged trades. Traders watch price levels without entering stop loss order on platform. Closing of trade is done manually by babysitting the trade. Usually you do that when you trade the news. Let's say that you want to trade NFP, and what would happen if you trade NFP? You probably know you will be very nervous, and it can happen that the price really, let's say that you went long here, you went some 20 pips in profit, but then suddenly trade reverses, and actually you saw 20 pips of profit, and now you're seeing a loss. If you're highly leveraged, you don't know where to put stop loss, but you will pay attention to your equity figures. And once your equity is really bad, you will use your mental stop and stop your trade. So proper technical stop would be here, but your mental stop would be somewhere around there, because you didn't have a patience as you were so afraid of losing the money, and you just close your trade without placing a proper stop. Mental stops are the worst type of stop losses, and usually traders do mental stops when they are rookie traders, but some advanced traders also do that. When they go, let's say that you go long 2 lots on 10,000 account, and you are 15 pips in profit, that is $300 of a loss. Usually at 17, 18, 20 pip, you would basically close your trade because it went almost $400. It's 4 or 5% of a loss in a single trade, and then you will be very, very badly wounded. So I don't recommend mental stops. Always trade the method, always trade the proven method, which actually can tell you what stop loss should be. So mental stop, forget about it. Then there is a time stop. Some traders use it. A time stop is usually based on a predetermined time. It uses a candle close, 1 hour, 4 hour, daily. It uses a daily close or hourly close of the candle, and also it's applied prior to big news, weekends, and when there is no volatility. Let's say that you basically trade only 1 hour charts solely, and that means that you will trade only 1 hour candles. That would mean that if you place your long order there, exactly you're trading 1 hour candle. You will, at this candle, you will close your trade, but you will put your stop loss basically somewhere around there. Or you actually will trade without the stop loss, but after the candle closes, you will close your trade, whether your trade is in profit or maybe it's not in a profit. So hourly stops are used. Usually after 1 hour, you will close your trade. So it doesn't matter if it's in a profit, you will close it in profit. If it's in a loss, you will close it in a loss. Some strategies can apply time stops, fake out strategies, or those strategies which basically are scalping on intraday time frames. But I don't do that. I don't use time stops, and I really don't advise using time stops unless your method explicitly tells you to use it. Then there is fixed stops. Some systems methods use fixed stops, and usually it's between 20 and 40 pips fixed stop. There are no many methods which are successful with this, but sure, if there is any, then it should have been thoroughly tested. That means that if someone is giving you the method or a system which uses fixed stops, then that means that they have thoroughly tested the method, and they know that their system or method usually goes well and within the borders of 20 to 40 pips. Usually that stop is 30 or 35 pips. It's fixed, so it's usually 20, 25, 30, 35, or 40. So it's a form of a technical stop, but more sophisticated, and it usually works with the certain method. And I put the 30 method. So there is no many methods which have been thoroughly tested to work with fixed stops. I personally on Camarilla MacDo do not use fixed stops. I usually watch that my stop is, I usually put my stop loss within the boundaries of 30. Why? Because I will show you that later. You will see how I do it, and basically it fits in that. So my stops are usually in between technical and fixed stops, but it's more of a technical stop than it's a fixed stop. But yet, if I use 30 pip stop loss, which I use 80% of the time, that means that my method is well within these borders. But I actually didn't invent this. It just fits in. If I see that my, let's say, lower low and support is within 23 pips of my entry, I wouldn't use 25 pips. I would use 30. If I see that my stop is 25, 26, and there is also a big level there, I will still use 30. So even though I don't want to use those fixed stop, very often it happens that on my account stops are 30 pips. And you know that from session recaps, when I do session recap and I said, okay, I will go long there, 30 pip stop loss, I would go there. That means that that fits into my methods. We did that great. We had a great trade with cable. Initial trade for cable was 25 pip trailing stop, and actually price came within 20 pips, but it didn't hit stop loss for that cable trade, and it was very, very good. That trade initiated after our session recap. Then we have technical stops, most common way of setting stop loss orders. I also use mostly technical stops. It usually uses strong technical levels and or swing highs and lows, which again fall into the category of being technical. So I can say that all chart stops are basically technical. And those technical stops are, as I said, the most common ways of setting stop loss orders. Basically, if you use technical stops, then your method or a system advises you to use that. Or you maybe know that, let's say that if you went long here, at this point you would usually place your stop few pips below the lowest low prior to your entry. So that is basically technical stop, using higher high or highest highs and lower lows or lowest lows. This is, let's say, a technical stop, and let's say that we made an entry here. Our stop would be, let's say, above this level and plus 10 pips. So basically it's a technical stop. We are using higher highs. If I made my entry here, I would place my stop loss here. If I made, let's say, a long entry here, I would place my stop loss few, I don't know, 5, 10 pips, whatever you deem, whatever you choose. I usually use 5 plus something. So I would use 5 pips below this candle. I don't go with 2, 3. I usually place 5 stops below the candle. Now, I will also tell you later about fixed stop, because fixed stop and technical stop combination, how I use it. I will show you on a real chart. So what stop loss to use? The method or system should tell you what kind of stop to use. I don't recommend mental stops, and if you don't know how to trade big volatility news releases, don't trade it. Mental stops are usually 90% losses. That will do a little play with your mentality. And you know, when you have a 10,000 account and when you see that your trade is making $350, $400, $450, even though if you're, because you're using big leverage, you would close your order. You wouldn't respect your stop, because risking $800, $900 on a single trade on 10,000 account is nonsense, guys. It's stupid, really. It's very stupid. So I always do that. That is why I'm also successful. I usually use 0.30 on 8, 9, 10,000 accounts. So 20,000 accounts, I can use 0.60 or maximum on one lot. But that is basically how you should, the risk management. You need to lower your risk if you want to stay in the game. Usually you need to make a compromise between time frame trading and next support or resistance level. So if you scalp, your stop loss shouldn't be more than 15 pips, but also it shouldn't be less than 15 pips. That's a general rule. If you do intraday trading, usual stop loss is between 25 and 40 pips. On longer time frame trading, stop loss is substantially higher, and usually longer time frame use only swing highs and lows, technical stops. Usually those traders who trade longer time frames or higher time frames will use let's say last higher high if they go short, or last lower low if they go long. Intraday stops are dependent on systems and methods, so your mentor or system creator should advise you. That is why I'm, someone may ask me how I judge those free systems which I present. Well, I need to test it. I need to see it. And basically, I don't know what creator of the system made for a stop loss, let's say. But I use my common sense to say, okay, this is how you would place where you will put your stop loss once you're in the trade. Because the best learning of the Forex market is by trial and error, but it can cost you money and it can cost you your nerves. And then the second best, and maybe when you put aside that trial and error, because everyone can can learn if they apply trial and error, but it's too expensive. Then it's always advisable to find a proper trader who can teach you exactly how he trades and how basically what he does in order to make money. And that is called a mentor. And when you find a mentor or you buy a method which can give you free classes with your method and with your mentor, that is the winning combination. Because first of all, you will learn through various videos or various PowerPoint slides and examples how the system is traded, and then usually proper mentorship also gives you one or two free classes for questions and answers. So you can basically also ask whatever is not clear. So my general advice is to find a confluence. This is how I advise traders who basically do not trade systems or methods which we use or which I use, and generally this is my general advice. So this is important. Find a confluence of technical levels to place technical stops. Let's see it live. Okay, this is it. This is a part of Camarilla MACD. So let's say that you basically, okay, let's use this pure example. Let's say that you want to made your short entry here at H3. Why? Because at the time while you were watching the potential trade, you saw that there is a confluence of, I don't know, a trend line. There is also a fib level 50 and H3. So basically you want to place your entry somewhere around this level. Basically what can happen is you will come here and you will see that it gives you basically only because we traded here. Let's say that we have traded here. Your prior high was only 5 pips, and this is prior high. Because at this entry, at this point, we didn't know that this candle will go here. So your prior high was this. But actually it's too low. It's only 4 or 5 pips of your entry. So the best suggestion I would use is to place your stops, of course, above the next resistance, which in this case is this fib. So in this case, this is fib. And where would you put your, of course, stop loss order? Somewhere around here. So really it's a small loss. It's 15 stop loss. But as I say, I usually don't go unless I'm scalping with 15 pips of a stop loss. So let's say that 15 is the minimum. And this is actually could have been very, very good. Now let's see other example. Let's see basically, I will remove this Fibo line here. Let's say that you want to place your entry here because this pattern looks bullish. This pattern looks bullish. It's a form of a piercing line. Although it's not perfect, it still is. It's a bullish pattern, and it was very close on L3, while the general trend on GBP is up. So basically, if you made your entry here, let's say here, somewhere around there, where would you put your stop? Of course, I wouldn't go with 5 pips below the level. Why? Because we have L3, and L3 is actually more important than this level here. So I would place my stops 3, 5, or 5 pips below L3. So actually, my stop loss would be here. You see, it's 17. I would use 25 or 30 pip of a stop loss. So that usually why it fits usually in my 25-30 pip of a stop loss is because I measure it like this. I made my entry there, or let's say we made an entry just at the close of the candle, as many traders would do. So my entry would be here, and my stop loss would be, actually it would be 25 or 30 pips, because I would use a last swing low because I'm going long, and I would use L3 level. Now, if you don't use Camarilla, actually you can do with any pivot point indicator, because pivot point indicators will plot your those levels like this. So actually, this doesn't have to be L3. It's L3 because I use and I teach Camarilla trading. But other methods also plot those support and resistance levels. So let's say that this is Fibonacci levels, Fibonacci pivot points, or I don't know, Woody pivot points or daily pivot points. Then the same logic is applied. Daily pivot point is actually more important than last swing low and last swing high. Why? It's because daily pivot point, or whatever pivot point is actually has more of the history in it than the previous swing lows and swing highs. Previous last swing lows or swing highs are actually near history charts. So basically you're seeing charts in the close history, near-term history. And the daily pivot points or Camarilla are basically a long-term history. Those have greater meaning because they are daily calculations of previous history. And this is only 15 minutes on 1 hour or 2 hour history. So that is why when you do intraday trading, my general advice is place your stops below, in this example, below of course this level, because you have a confluence of swing low and a pivot point. Or let's say another example, let's say that you have if you want to go short, of course, and here let's just for the sake of this presentation use this example. So let's say that you want to go short here. Actually, you wouldn't place your stop loss here or just at this level. You would be placing it some 10 pips above this green level pivot point, because actually it would be only 20 pips. It's 10 and 10 added, it's only 20 pips. But it has more strength because you see the price tried here to break it, it didn't break it, it went and it was rejected again. Only at this point, but it happened after 10 hours of trading. So when you do intraday trades, usually this pivot point and swing highs or lows will actually work out for you. And that is why I like to place my orders just like that. Of course, there will be many examples when those pivot points and swing highs and lows actually made a perfect confluence. Let's say that our swing high was here, actually, here, somewhere around there, and we want to trade it short. Actually, I would place my stops above the last swing high and the last resistance, which is actually H4 of the Camarilla. So that is how I place stop loss, and it actually fits perfectly into my rule of if I make entries on 1 hour time frame, it's actually in between 25 usually and 30 pips. Sometimes it can be 20, but you know, usually it's around about 30 pips. So that is what I wanted to share with you, and that is how I actually advise you to trade if you're trading with candlesticks, trend lines, and pivot points. So use confluence of pivot point and swing high or low for placing your stops. And usually if you do with 1 hour trade, use around about 25 to 30 pip stop loss. It will be good if your method is also good. And just remember that trial and error is basically the most most expensive thing which you can do. Now I will give the presentation to Chris, and he will also share his thoughts, guys. And later, if you have any questions, you can ask. Thank you. And Chris, I will connect you. So thank you, guys, and talk to you very, very soon. Don't forget to ask any questions if you're not sure about this.
Great stuff, T. Thank you so much. Comprehensive, but I'll do my best to add some additional light on this topic if I can get this PowerPoint going. There it is. Alrighty. We can go through this part, and well, just a quick rehash that, of course, it's logical that we need it because we're losing leverage, and with stop losses, obviously, we are not necessarily using a stop loss just to make extra sure to protect our trade, but to protect our trading capital, right? That's the primary focus here, is to make sure that we have enough capital left to trade in our day, right? Of course, our primary goal in the long run is to make money out of it and profit out of it, but we can only do that if we ensure that we have capital, because that's our inventory. How do we ensure that we have inventory and our capital, trading capital, is by using a stop loss, because that way we can make sure, or very high percentage make sure that we limit our risk to a certain part of the trading capital, such as a 1%, for instance, so that we don't spill the beans or lose everything on one trade or a couple of trades, right? And that's important, obviously, because trading is you know, it's a probability, right? Nothing is for sure. No one knows the future of the market. So we have to realize that we have losing streaks, winning streaks. We have to calculate that that could happen. How can we make sure that the losing streak doesn't wipe us out? Is by using a stop loss and by having this risk management and controlling risk. Risk isn't a bad thing. Risk is good because it allows us to capitalize on opportunities. But we have to control it, though. That's one thing that's for sure. So that's why we have it. As I talked about already, how to protect our capital, basically by using a stop loss. There are other things that could be used, but they're definitely not as desirable as the others, and not so practical in most cases. So when using a stop loss, basically timing becomes very important of a trade, because an entry could be good if you, let's say, exchange your own cash value at a 1-to-1 leverage. There's less risk. You don't really need a stop loss because you're risking, let's say you're risking 1,000 euros of your savings without using leverage. Well, that value becomes maybe 960, but it's not like you're going to lose the entire sum. That risk is very, very small, and it goes down to 960, crawls up back to 1,050, and that's it. The entry is not as important. Obviously, if you're using leverage, the timing is very important, right? It's actually very crucial, because an entry could be very good, but if not properly timed or exited, it could be a loss. But then we see the trade develop our way, and it could have been, or maybe should have been sometimes, as we think, a winner, but the net result is a loss. So, you know, that entry is definitely important, but obviously the trade management, the timing, and the exit results give the result of the total trade. Now, the stop loss is a sensitive topic, I would say, from a psychological point of view. It's not easy to cut losses short in general. Why? Because we have hope that the trade continues our way, hope that it still bounces, hope that we might see a miracle. We have fear that if we do exit, that the trade will go our way. We have greed that the trade will go our way. So there are a lot of kind of emotions here involved, and it depends from trader to trader which ones would affect us the most. The best advice I can give is really looking at it from a very kind of like almost like a cool way. It's maybe difficult to explain, but almost like a not emotionally attached way. You know, so when a development happens and you make a decision, it's best just to not look at the pair, and not think twice about the decision that was made, and not especially get emotionally disbalanced by the decision made. You know, there's always that thing about moving the stop loss, and then you get kind of like annoyed by the fact that you did that. You see that you're going away, and you get disbalanced, you get upset. Still join the trade again at a worse price, then the price actually goes against us, you know, and all this mess and trouble, right? You want to absolutely, at all costs, avoid these costly events and mistakes. And it's maybe not as easy depending on experience levels. That will depend from trader to trader who's listening here. But in general, you want to get to that stage that you're just executing, you're just trying to implement your plan as best as you can. You're trying to, of course, get the best plan you can have, and that's the goal, not to predict. And if we have the tendency, if we want to try to predict, then these emotions tend to arise quicker in general. Although emotions can always arise, we need to, at least if they occur, we want to recognize that and have appropriate actions, like either having a mental break or literally stopping and going for a break, or maybe even not trading for the entire day, depending on the situations. So anyhow, I went a bit further into that part. Let's see. So stop loss placement is influencing not only our psychology. I was talking primarily about the psychology part, how we have to just accept that losing is unavoidable part of trading. In, let's say, other sports, you might be able to avoid losing. There's some, let's say, very excellent football teams that could be able to avoid losing the entire season, although it's very rare. This is certainly impossible for a forex trader because that's just part of trading. There's too much, it is not like a academic field that we're in that 1 + 1 is always 2, for instance. It's not that black and white. So that's the psychology part. But it also influences our money management part. And that is also, of course, crucial for the system expectancy. What is system expectancy? It basically looks at how much we win when we win and how much we lose when we lose, and how many times that occurs. Right? It's not about being right or wrong, as we often say and often discuss and mention, but it's about how much when we lose and how much when we win. That difference. Now, what is influencing those ratios? Obviously, when we exit and obviously when we enter. The stop loss influences obviously when we exit. Stop loss, in most cases, or many cases, is exited at a full loss by many traders. That's possible, but you do need to compensate full losses with a lot of profit, either by a lot of profit or a high win percentage. There's no other way otherwise to get positive system expectancy. That means a high win percentage or a very high winning average compared to the average loss, right? Let's say we have a lot of full losses, but for instance, we have 70% win percentage. Well, then we can handle those full losses in most cases, right? Depending on what the average win is, though. If you have a high average win, about 3 times as much as your loss, right, then, okay, fine, you could have maybe only a 40% win percentage. But it's still, on average, an expected win. This is crucial for finding a success. Looking at your statistics and understanding what might be wrong in those statistics could be in immense value to anyone trying to understand what their trading is saying. Statistics do have a story, do give insight in what could be going wrong if you don't have system expectancy positive. If, for instance, you have a system expectancy where you're taking, and you look at your stats, and you're taking small wins, and then big loss, small wins, big loss, big loss, big loss. Well, obviously you're cutting your winners short, and you're not and you're letting your losers run, right? It should be the other way around, right? So there, depending on what strategy you have, you gotta have to flip it around somehow, right? And work on it step by step to get that equity curve into the right direction, not down, but up. Stop loss and the usage of it and how to use it will heavily impact this ratio. And Nanette already discussed a lot of things regarding stop losses regarding the placement of that. So, in my opinion, very important to place technically correct stop loss, although if you are trading intraday, you might want to think about the size of it as well. I don't think it's best to use a fixed stop loss, but unless you're using a scalping system, that you want to make sure, because otherwise you cannot have. Why is that? Why would it be good for a scalping system? Because otherwise you don't have a good enough average win expectancy. Stop loss above support or below strong resistance is good. And usually, if you want to trade intra-week strategies, use the support or resistance of one time frame higher. That's a practice recommended by Bill Williams. So go to one time frame higher, look where the technical stop loss there is. That is an extra safe stop loss. Let me show you on the charts here quickly. You're trading the 50-minute chart. Go to the hourly. Where is the bottom on the hourly? Okay, so your entry is on the 15, but you zoom out one time frame and you look at the hourly. Your entry is on the hourly. Where would you put your stop loss? Zoom out to the 4-hour. Look where the bottom is in the 4-hour. Put the stop loss there. That is an extra safe stop loss placement. Okay, because it's going one support or resistance away from current price. Other things to consider: which currency pair are you trading? Sorry, which strategy are you trading? Which time frame are you trading? What is your trading character, trading psychology? What is the structure of the market? These are a lot of things. I don't want to dive into that too much. I want to look at charts together with you in just a second. But obviously, the currency pair, it could vary. Pound dollar will have more spikes, so that's something you might want to take into consideration. The audio USD will move slower. What strategy are you using? Obviously, if you're scalping, you're going to use a smaller one. If you're swing trading, it's going to be wider. That's already discussed. Same thing for the time frame. Trading character, same. It depends on what kind of equity curve you're looking for. All right. If you're looking for a high win percentage, then you might not want to use a very tight stop loss. Or if you're looking for, let's say, a very high R2R ratio, then you might want to use a very tight one, right? And what is the structure of the market? Obviously very important for technical stop losses. Things to consider: I use fractal indicators, tops and bottoms, swing highs, swing lows primarily. But I think that Tarantula definitely showed how important it is to use pivot points. I sometimes use even Fibonacci's or confluences of that, candle highs and lows. I use sometimes chart patterns, not so much this one though. Sometimes this the other way, but it depends if it must be definitely a swing trade. All right, and even some people use trend lines, although I don't use that one that much personally. Obviously, support and resistance is always important, but all of these are support and resistances. So let's take a look at some examples of stop losses on the charts. What can we think of for using stop losses like a day-to-day? Now today, in my opinion, didn't have much of a great movement, but one of the things that could have been traded, for instance, was this audio is the downside. For instance, if you traded this break, right? Now, in this case, it was quite a straightforward element, but upon the break of the trend line, naturally one might think of a stop loss above these tops. I don't think there's anything necessarily wrong with it. It worked well in this case. It was about maybe 17 pip stop loss. I would have had some issues with the pivot being pretty close by and the H3 close by. So in this case, if you go 5 pips above the H3, it would have been about 40 pips, which is a bit high for an intraday trade, but it's still going your way, so would have given a bit more security in that sense. These are the issues you always have in suboptimal situations. Personally, I was hoping for a hit of the pivot. That would have been nice. Didn't get there. These things are practical issues when using stop losses. The tight one in this case would have worked well. If one was looking for follow-through, I would have taken this break here instead of the first break. Let's say the continuation instead, right? Then this level would have been okay for me, because if you're pushing through this particular orange line, or let me just move the magenta line here lower. If you're pushing through that magenta line, then using this makes sense, because when we push through that, price going back all the way here seems very unlikely throughout the day, and then it does make sense. All right? Maybe even a tighter stop loss. Maybe sometimes I use the moving average even in a trending situation. I would not ever use a stop loss in this situation right at the moving average, because it's only 6 pips away. It doesn't make sense. Well, ironically enough, it would have worked in this case, but this is just an exception probably, or we would have to at least test how often this would work and how often not. Obviously, I never did that, but it seems to be very tight to me. Things start to change because this is the first breakout. Things start to change if you have a break, pull back, continue, and then things look differently, because you got an average you got a angle on the moving averages. All right. So in that case, the moving averages sometimes provide some usage, for instance, and that we get followed through. Now, personally, trail stop losses are, in my opinion, a good thing, depending on how you trade. Logically, it is something of a decision that depends on what time frames you use. Okay? If you're using scalping strategy, you're probably not going to be much of a use of it. But if you use something more of intraday swing or a swing trade, it could have its value, because you're not cutting your profits necessarily short, but sometimes you get bigger moves. And it maybe allows you to stay in a trade longer. Personally, I like it in some cases because it allows me to catch bigger expectations of R2Rs. Okay? So in that case, you're not limiting your profits, and you're allowing your runners to run, and you're sometimes even cutting losses short. Cutting losses short has its, its advantages. It's pretty good advantages, in fact, because in some cases you could only have a 0.2 loss or 0.1. It has a tremendous effect on the average loss, and if you have a small average loss, you only need just a bit of more average win already to have 2 times the average win compared to average loss. So it's definitely something I would recommend to look into, of course, depending on your psychology as well. It depends. Some of you would not like that, and that's fine. There's nothing wrong against it. Personally, I liked it because I had a tendency sometimes to take profits prior to my TP just a bit earlier than I wanted to. And trading stop losses helps me with that particular element. Let's see. Other examples. Pound yen yesterday had a lot of downside. We looked at it yesterday, pound yen, saying that this could be an interesting level for shorts because we had a drop here. Not sure exactly what the Camarilla was yesterday, but in any case, I remember clearly that we were saying that the 50 fib would be an interesting level. Look for a bounce there, and we got a big fall. Now, what kind of stop loss were you thinking about? Well, obviously about above here, right? That makes sense. However, if we break this bottom, then maybe a tighter stop loss, well, not a tighter, but above here could make sense, right? In this case, this is pretty straightforward, and this is something we discussed in the trading room yesterday. That is in the mornings. By the way, if you're not sure when it is or haven't joined yet, that's in the mornings, Tuesday, Wednesday, Thursdays. And that was a good trade and a good fall on this. And if you use a trading stop, you can see that, yeah, an exit right about after, well, depending how you trail stop it, but if you use the fractals, for instance, you could have exited here, for instance. Good trade, right? Especially if you compare it to the risk. So this one is pretty straightforward. And we can take a look at something else. What else? maybe the euro odd, for instance, that had an upside day today. Obviously, here we had a break. Like this. This is a triangle. This is a breakout scenario. In this case, one could use a tight one. I'm not very fond of using tight stop losses with breakouts personally. However, we do have two fractals on the hourly chart here. So instead of maybe using a very tight one, one could have used maybe this bottom instead. That is one time frame higher and would have then thereby qualified as a one time frame higher stop loss, therefore increasing the likelihood of it acting as a decent level. That could have been the stop loss here. Trading stop loss in this case wouldn't have gotten too far, depending how you trade a stop loss. If you use the moving averages, obviously you're still in that trade. Had a bit of a struggle, but is now slightly continuing, broke above yesterday's high and the H3. So there was some space here to that level, and you see that price indeed stalled there. So I think personally, if you have doubts, using a one time frame higher certainly helps with the reliability of the time frames with breakouts or trending modes. Reversals is another story. Reversals, you definitely want to be aware of the fact that you could easily get a break of the top or bottom by a couple of pips. I don't trade reversals too often, but in this case, for instance, like the pound dollar, I would certainly be more inclined to put a stop loss about 15 pips above the top or bottom, because you can always have a small break. Let me give you an example of the odd CAD here, for instance. This particular one is a great example of how taking shorts could make sense, but you got smaller breaks at the top continuously. Obviously, if you go extremely tight above the top, then it's going to be a headache here. Depending on how you trade the reversal, it's something you might want to consider. Not using the direct top or bottom. So I'm primarily talking about trending modes, breakouts, more intraday or intra-week / swing trades. If you're using position trades, I think it makes sense to, and I mean, now I'm talking about daily and weekly charts. I don't think many of you maybe are trading that way, but if you do, that there's definitely people using mental stops, I would say, in those time frames. Intra-week, intra-day swings, it's good to zoom out one time frame, I would say, and primarily when trading trend and breakouts. If you're reversal trading, that art of stop loss becomes even more difficult, especially if you're trying to trade the exact turning spots. Right? Obviously, if you have more confirmation of a turn, then it becomes different. Let's say you're looking at 1, 2, 3, 4, 5 candles here. Then this particular high has more strength, has more validity than just when only this candle is posted, right? That we don't know how far it can go. It could still continue. That's a lot more riskier. If we already have a turn in play like this, things change. Then this level becomes more solid. All right? So, moving the stop losses, never move stop losses further away from price. Only move it closer to price action, lowering the risk, in my opinion. Because otherwise you're increasing the risk or cutting, maybe reducing the profit. That I would not recommend. Take a look at time factor. That could be an interesting, something I just discussed now as well. There's a recorded webinar you can find in the archives. And regarding time factor, using a tight stop loss is okay, but in general, you would probably notice that the trade has to develop quicker in your way. All right? Wider stop losses will allow more time for the trade to develop. Choosing last but not least, choosing a stop loss where your trade concept or setup is validated. is preferably the spot you want to choose, if possible. So I think those are the main important points, in fact, in this PowerPoint. Take a look at time factor. Could be useful in understanding the relationship between price movement and how fast we can expect the development, and when a tight stop loss or a loose stop loss might be better in which scenarios. There's a webinar on that, so take a look on that. Checklist, plan your trade before you enter. Obviously, very important to know where your stop loss will be or is upon entry, not to start looking for that after entry. That's basic, but it must be mentioned. Otherwise, I think we basically mentioned all of these things. Never increase your stop loss size, as I said. Follow your plan and be patient and disciplined. Well, folks, now it's your time to ask any questions or comments you have. By all means, please do so. In the meantime, take a look at our webinars next week. Learning Labs with Tarantula and Expert Advice, in fact, as well on Monday and Wednesday, 6 to 7 p.m. And then our live trading labs Tuesday, Wednesday, and Thursday. And of course, in these webinars, you can always ask a question about stop losses, with practical situations that you would like to ask. All right, this is of course giving an indication of what you can think of, but maybe I have a practical question. Well, that you can always try to ask at the end of the webinar, or in my case, with the live room, we have enough time to answer that question right away, probably. So by all means, you can always use those moments to ask practical questions as well. I provide the analysis there in these webinars, but I definitely very welcome questions that could help you. And I mean, questions that I can answer, hopefully, that will help you, right? Doesn't happen too often. I guess maybe people are shy or are just happy to listen. But I would encourage people to use this opportunity. Why not? Let's see. I have a question from Priyanga. I don't have that. Maybe Nena does. I'm not sure. You can ask him.
Yeah,
Chris.
Chris.
In social media.
Yeah, Chris. Sorry. I see the question. Indicator for pivot hourly points. I'm not sure. I think if you think about a hourly pivot points, that's an indicator which is, I think, paid indicator. So I'm not allowed to share it freely. But I think maybe in the due time I will. But at the moment, I think for hourly pivot points, if that is the indicator, it can be shared. Camarilla, though, can be shared. You can also find it free on the internet. But if you want Camarilla, which I use, just send me an email and I will give you an indicator for Camarilla. But that indicator which I showed you, it's not hourly pivot points. It's Camarilla indicator. So that's it, Chris. Chris, I think we are over. You're welcome.
Yep. Let's see. No questions. So everything is clear, I guess.
Yeah. It seems there are no questions. Everything is clear concerning stop losses. Okay, guys. Thank you for following us. Thank you for listening to us. Soon we will be here again with you. And of course, as always, follow me and Chris, our updates of the trades, and actually trade safe. So thank you for listening, and cheers.
Yes. Have a great weekend or trading tomorrow, and see you all soon. Cheers.